again, good morning or good afternoon to all the advisors joining us today. For those of you that I have not met, my name is Alex Chan. I'm the Regional Wealth Leader for Western Canada. And joining us here today as well is Graham Allen, Regional Wealth Leader for the East, as well as Vic Raye, our National Director of Banking Services. And we also have a guest speaker today, Sadaf Chowdhury from Desjardins, but Graham will do the official introduction and also lay the groundwork on the reasons for the presentation from Desjardins today. So once again, thank you everybody for taking the time to join us today. And it's hard to believe that we're almost into December. So with that thought, when we're putting together this presentation today, I thought we would start with some year-end financial planning tips for advisors. And we've put together the top 12 year-end tips that we feel are quite relevant at this time of the year. And these tips come from myself, Graham, and Vic, our years with working with advisors, and also our years as an advisor ourselves. So we'll get going. So our agenda today, again, the top 12 financial planning tips. Normally, this is about a 1-hour presentation, and I only have 20 minutes, so I'm going to be speaking pretty quickly. And I'm going to spend a few minutes on each of these top 12 planning tips. So the first one, review and rebalance holdings, identify RIF and LIF clients. I'm going to spend a few minutes as well on year-end tax loss selling and harvesting, charitable donations, TFSA withdrawals before the year end, RRSP top-ups. Those of you that have clients with employer-sponsored group RSPs, doing top-ups for those, matching and also matching for this year. Going forward for 2023, employer-sponsored RPP group RSP contribution elections usually have to be done around this time of year. And also on the life insurance side and investment side with seg funds, reviewing all the beneficiaries for the insurance and seg funds. And of course, with that, reviewing all of the insurance that all of you advisors have to offer: life insurance, DI, CI, and of course, group insurance. And also to review mortgages that your clients hold on personal or investment properties, personal lines of credit, and I'll talk about that as well. And also just in general, planning now for 2023. So rebalance holdings, year end is always a great time to review and rebalance. And again, especially with new money that's coming into the portfolios, again, maybe some underweighted holdings that you may want to rebalance into. And also when it comes to rebalancing, it also can be rebalancing for asset classes, not just the investment portfolios that you manage for your clients in seg funds. So your clients may also hold stocks, bonds, cash, GICs, other investments, and also par whole life, which is also an investment class within itself, and real estate. So it's a great time to kind of have a look at all of those asset classes with your clients and kind of see where rebalancing can and should be done. Risk tolerances of your clients may have changed throughout the year, and they also may have different financial goals with all the stuff that's happened in the last year. And also it's a great opportunity to talk to your clients and see how their other investments are doing. You can ask them if they're happy with the advisor, the relationship that they have, the service that they're getting, and also are they happy with the performance. Um, Open accounts or non-registered accounts, seg fund, mutual fund rebalancing. At this time of year, we all have to be very careful of allocations and distributions that are not proportionate to the time held. So with that, you may want to hold off on large non-registered investments until January 1st. Or if the client is ready, willing to write the check, you got to strike when the iron's hot. Maybe open up the account and dollar cost average into the market is a great strategy as well. Identify RIF and LIF clients. Of course, clients have to RIF or LIF by the end of the year that they turn 71. And of course, RSPs to RIF, LIRAs to LIF. And again, it's a great opportunity to consolidate assets held at other institutions. And usually clients going into retirement, they do want to consolidate, or they really want to deal with one advisor to keep things simple for their family. And again, with many of the insurance companies out there, when your clients are turning 71, there will be a seamless transition from RIF or LIRA RSP into RIF, LIF into LIRA. And again, if you don't reach out to your clients, some of the insurance companies won't pay you. So now is a really good time to be sure that you do reach out to the clients and complete the paperwork and don't let it happen seamlessly. Tax loss selling and harvesting. This is probably a presentation within itself, but I'll just spend a quick minute on it. Many of your clients in the past couple of years may have had huge capital gains. So again, maybe consider some tax loss selling at year end, to offset some of the previous 3 years capital gains, because you can go back 3 years. Or you can even do some fund switching to trigger a capital loss. And this capital loss is still eligible for other capital gains, such as a sale of a business. Charitable donations, again, must be made before year end for tax deduction for our 2022 tax year that we're in. And you can do a maximum of 75% of your net income. I know that sounds a lot, but sometimes people come into money and, they want to make a big charitable donation. So you can do 75% of your net income. Unused donations as well can be carried up to 5 years. So again, some tax planning can be done to maximize these charitable donations. And with donations, like many things in our tax system, donations can be shared among spouses, all of them, or just some or a portion. So again, comes down to some tax planning there. Terminal tax return, it can be 100%. Charitable donations can be made in the year of death or the year prior. So again, on terminal tax returns, there can be some charitable donation planning there as well. Tax-free savings account, believe it or not, the maximums now are $81,500. I remember years ago when TFSAs came out in 2009, it was $5,000, and a lot of advisors say, "Oh, I don't want to, go and open these accounts or use time to talk to clients about them." But TFSAs have grown into, quite a large market, being able to collect 81.5. So for a couple, that's 163,000 contribution and sale if they've never contributed to tax-free savings accounts. And again, at year end, your clients may want to withdraw some TFSAs before the year end, because if you do withdraw, you do get it back come January 1st, 2023. So they think they need money in January, take out the TFSA now. RESPs, again, contribute $2,500 before year end, and that will provide your clients the maximum $500 grant, or 20%. Children already in post-secondary, you may want to consider drawing their EAPs, that's the Educational Assistant Payments, before year end. So EAP are the various grants that you receive from the government, including the Canada Learning Bond. So these are taxed to the student beneficiary, and usually they're in a very low or no tax bracket. So again, it's a great time to pull that money out of any RSPs that you have. And just a quick reminder, for seg fund or ESPs, we have those available with IA, My Education, which is self-directed, or Diploma, which is more of a group style plan. And of course, with Manulife, we do have RESPs as well. Group RRSPs, right now, you may want to look at employer matching. Again, if there's a matching program, you can make the maximum contribution, help your clients do that. So they'll get the maximum contribution from their employer. And again, now is a great time to plan for what your clients plan to do at work for 2023. And again, we've always said that, if their companies are willing to put in $1 for every dollar that they put in, or whatever the formula is, I mean, they really should try to maximize what the employer puts in. RPP, again, now's the time to plan on matching or maximizing employer RPP contributions that they're going to be doing in 2023. And usually this must be done before the year end. So now is a great time to talk to your clients that are in an RPP and set the stage for next year. Reviewing beneficiaries, beneficiary designations. Again, now's the time to review the products and confirm who the beneficiaries are for the plans that they have named beneficiaries with. And also confirm with them that the wishes will be met having the correct beneficiaries, because oftentimes beneficiaries are designated, years ago and may not be current. So now's a great time to do that. And again, with beneficiaries, now is a good time also to talk about seg funds and how we can have the annuity or the legacy settlement options. Again, these are for beneficiaries that maybe are spendthrifts, or the owners just want their beneficiaries to receive their money over time. And again, that can be accomplished, really easily, efficiently, and at no cost with an annuity settlement option. With beneficiaries are really warm leads. Ask your clients, hey, is it okay if I reach out to your beneficiaries? Let them know, what you've set up, and they will be a beneficiary, one day. So again, it's a warm lead, and they're always very open to, talking to you for what you've set up for mom and dad, or, grandma or grandpa. And again, reviewing all of the insurance that your clients have. Usually this comes into play with year-end reviews. Again, whether it be their personal policies that they have or group coverage, now is a really good time to review all the insurance coverage, held personally or through the employers, and really, do your best job in blending the two to maximize their coverage. Again, we always say this, that they have adequate insurance if they die too soon, suffer an injury or sickness and can't go to work, or suffer a critical illness. Review mortgages or any lines of credit. Make a note of referrals or renewals. And again, I know Vic's going to talk about this, to position BMO and Manulife Bank, who of course are our mortgage referral partners. And also, don't dismiss renewal dates that may be 4 or 5 years into the future. Make a note of them. And, if you consistently do this, these mortgages of your clients will eventually start, coming up for renewal. And these are warm leads to, again, talk to Vic Raye about, or send to your, banking specialists at Manulife or BMO. So again, plan for 2023 at 2022 year end. Don't ask for too many general referrals, like, who do you know? Can I get some referrals? Because if you're too open about that, you won't get any. Again, now is a great time to look into writing a financial plan for year end. Again, IDC Worldsource, we have arrangements with Razor Plan or Conquest, so definitely reach out to your BDE RVP or Graham, Vic, or myself if you want more information on that. And back to referrals, there's one tip I learned from a very successful advisor on referrals, to be very specific. And he used to ask his clients when he was doing reviews, he would say, okay, Graham, who are the 2 wealthiest people you know personally, and why are they so wealthy? Oh, Graham, can you tell me a little bit about them? And this way, you're asking them specifically for just 2 referrals, and you're very specific in asking that, who are the most wealthiest or successful people that you know. So again, that's a little tip from me today. So really, my apologies for going through this so quickly. Again, my presentation and everyone's presentation today will be uploaded to Win Big, or if you want a copy of it in advance, please reach out. There's my contact info, Graham's contact info, and Vic will share his later. So once again, thank everybody for their time today. And I am now going to pass it over to Graham. Thank you all.
Great. Thanks very much, Alex. Lots to think about, and hopefully everybody in line takes at least 3 out of the whole thing and works with them as we plan for 2023. So I have a very limited amount of time here to set this up, and I want to make sure Sadaf gets as much time as possible. We met within the last 6 months, hit it off, and Sadaf brought a topic to me that I thought was really quite important, something we should be sharing to everybody. We were not originally scheduled to do this on this call this part of the year, but it's very timely and something I think everybody will be interested in. Part of the job that myself and Alex do is to meet with people like Sadaf and industry providers or manufacturers, keep update with product and hear about new ideas, and then obviously provide those solutions to you, the advisors. And this one here is unique to Desjardins. It is very topical to market conditions that we have right now. And I think most importantly, it will give you an opportunity to speak to your clients and bring them something that's very, very positive as we run into 2023. Many of them will not have had such a positive year this year. And that's been a real surprise considering how the markets have been in the last decade or so. They're not being used to volatility or even sideways movements. They're being used to positivity all the time. So this is a product that can really jump into that gap. I don't want to I'm not letting the cat out the bag. I'm going to let Sadaf have that pleasure. But I'm going to hand over to him now. Sadaf is a regional director with Desjardins. Has impressed me immensely over the last, as I said, 6 months or so. And I am really looking forward to this presentation. So over to you, Sadaf.
Awesome. Thank you so much, Graham. I'll take a quick moment in sharing my screen. Good afternoon, everyone, and thank you to the IDC team here for having me present here today. I do look forward to working with you all more closely in the new year. Speaking of new year, it is fascinating how we're approaching the end of 2022. We're knocking at the doors of December, and it's been another tumultuous year. I mean, to be honest, since COVID, I've lost track of how fast times are flying. There's always something going on. But COVID has completely exacerbated the damages to the economic and financial system over the last few years. We saw a high supply of cash being injected into the economy, supply chain disruptions, high level of government debt, and then obviously the record low interest rates that we had, stock market and housing market booms. So it was like the market was shooting off in all directions without any fundamentals. And that period actually reminded me of a very famous quote by Warren Buffett, which says, so the quote says, like, a rising tide floats all boats, but only when the tide goes out, only when the tide goes out, you discover who's been swimming naked. And what this really translates to is when things are going well, everyone's riding with the wave, everyone's making decisions with their emotions rather than irrationality. And only when things go downhill, the tide goes out. And we've seen this year, we sort of figure out who has been the most vulnerable. So it's a very timeless quote by Warren Buffett. And now the question is, how deep do we go down from here? Obviously, we've had a tough market this year. It's already slumped by a lot. Is there more to it, or are we at the end of it? Are we looking at a bull market run from here? A lot of us are bullish. A lot of us are still bearish, at least in the short term. But whatever your sentiment is, it really doesn't matter because we don't know what's going to happen. We're at a very uncertain stage in the economic and financial cycle. And the thing that prepares us for uncertainty is always planning and preparation itself. So today, at this presentation, we're going to be discussing some idea and talking about a solution that will help you prepare for maybe a possible deeper recession and also plan you for a bull market after that. So let's dig into the agenda. I always like talking a little bit about the markets initially, just to see where we're heading or where the forecasts are heading. And then we can tie that with the solution that we will be discussing today. So I'll start off with the market update, followed by the market linked term investment industry in Canada. Then we'll jump to the star of the show, which is our Guaranteed Advantage solution, how it works. And I'll end off with some ideas we can work with the solutions from there. Going back to some
economics team at Desjardins, inflation has been in the headlines all year, and the successive rate hikes we've seen to tame it. So obviously, it's not a surprise that this is the first in the list. Higher borrowing costs from high interest rates are causing the housing market right now to cool, and we're seeing effects of it in Q4 of this year. Since October, we're seeing some significant price drops in some areas of the GTA, especially, and in some other areas of Canada. And one of the things that our economists are saying is a major indicator of the housing market is the volume of listings showing up. So if we do have a high number of listings, this means that people are actually trying to sell their investment properties or even sometimes primary residences in order to, or because they cannot keep up with the payments. Throughout the whole year, we've seen those listings be stable, but since October, those listings are starting to increase, which is not a good sign for at least the housing market. And Canada's economy is tied to the housing market extensively. So we're expected to have a slow 2023, and we're already experiencing a recession. So, but amidst all of this, our economics team is expecting the markets and the economy to start normalizing in 2024 as the rates start going down. So that's some good news right there. This is a snapshot of the major economic forces out there and where the interest rates need to be, or the forecast of the interest rates by the end of 2022. So we still have one more month, and this is what the forecast is looking like. Speaking of interest rates, as advisors, we should always be on top of interest rate updates, inflationary updates, so the data that is released every month and few weeks that the Feds and the Bank of Canada meet together, because they are our primary source of information in terms of where the markets will head. It's not Justin Trudeau, it's not Biden, it is Bank of Canada, it is Jerome Powell, it is these interest rates and inflation data that will sort of give you an idea of where or how the markets will look like in the next coming years or coming months. So this one specifically is the FOMC dot plot, which is the Federal Reserve dot plot in the US. And this is published every quarter. And it illustrates where interest rates need to be by the end of the year to combat macroeconomic issues like inflation. So in June of this year, the Feds forecasted that, we have to have interest rates at 3.4%. That'll be good enough to tackle inflation. That was not the case. In September, they changed their forecast to 4.4%. And right now, when we're talking about that now, the Feds are now thinking, in the December meeting, they're expecting the forecast to actually increase a lot more, not a lot more, but a bit more for 2023. So we're looking at a rate of around 5 to 5.5% in 2023. And if that's the case, we still have another 75 basis points for US and 50 beeps for Canada in terms of rate hikes to go for 2023. So expect some volatility, expect some uncertainty. It will all again depend on other factors like inflation. But yeah, this is definitely dependent on a lot of factors. But how long can an average recession last? From all the data spanning all the way back to 1926, recessions in general only last, not only, but they do last 16 months, but it's only compared to the bull market we see after that. And the bull market we've historically seen after a recession is 10 to 15 years, historically again. Recession last 16 months, we're probably in the middle of it. There's still a few months more to go, but just position yourself for a good market run after a year or a couple of years. And this is a great time to start dollar cost averaging and building on and accumulate wealth over time. Last macroeconomic update that I want to provide you is about the US midterm elections. And this is, we have so many events going on this year in terms of economically, at least, that we forgot one of the key forces that affect the markets, which is the US midterm years and the elections. Now, the Republicans have already taken the House and the Senate is up for grabs, and it's a very tight race. But US midterm election years historically have been the worst performing years. And this graph here shows a 4-year presidential cycle on how the markets react to midterm elections. And we have seen that if you look into the midterm slot in the middle, markets go down, are volatile, regardless of all the various factors we have had. Even in a normal market condition, midterm elections years are generally tend to be very volatile and not generate a lot of great performance. But the year after that, which is next year, historically has presented a lot of opportunities. There's been a lot of growth and is usually the best performing years. And this graph really illustrates, doesn't matter who wins the House or Senate, the market always performs well. And I'd like you to focus on the box in the top right. Even if the Republicans or the Democrats take full control of the House and the Senate, the markets react well and they're usually much better. But even if they don't, even if we have a divided government, we still have a very good market after a midterm election, which is reflected in the numbers here. So I hope you enjoyed that little market update. Now we're going to sort of dive into the solution that we're going to talk about. With all this information that we've gathered, there could be another 10, 25% drop. We don't know, but the question is, can you afford that, or can your clients afford that? We do have a lot of clients who are in their retirements, who are senior clients. They cannot afford another 10, 15% or 15, 20% drop because the gains required to make up for it are significantly higher. So what we're going to be discussing right now is, before I jump into guaranteed advantage, is just the industry it is under. It is under the market-linked term investment industry, or market-linked GIC, as a lot of you might know it as. It's an industry that has been growing significantly, around 4.7% year-over-year growth between 2017 and 2021. But if we do include 2022, this jump, or the growth, will be significantly higher because of high interest rates that we have seen this year. And when interest rates are high, GICs are always better options. Market-linked GICs are also better options, and market-linked term investment or guarantee advantage also offer very attractive potential returns. So why should you be looking at something like this? Is because your fellow advisors are selling this to their clients. I know that from my experience working with a lot of advisors love to hear what other advisors are doing. And I can tell you from my experience dealing with a lot of advisors this year, there has been an influx of demand of solutions like this that provide guarantee, that provide some guaranteed returns, protection. These has been the buzzwords for this year. So go to the big banks, they're selling GICs and marketing GICs like hotcakes, and the features are also pretty competitive right now because of the high rates. So now we're going to talk about the superstar of the show, which is Guarantee Advantage. And firstly, it's a locked-in term investment. So it's locked in for a certain period of time. 2 years is the minimum that we have, but it also goes all the way up to 5 years. How it works is you, over the span of those 2, 3, or 4, 5 years, you will receive full protection on the principal at least. And it also participates with the market as the market starts going up or going down. But at the end of the day, you will receive full protection. You'll only participate in the market upside. So think of it as a maybe mutual fund, but you're only participating on the upside of mutual fund. And you're being protected from the downside risks. So that's how it works. The great thing about Desjardins Guarantee Advantage, which you won't find in other competitors with the market-linked GIC, for example, is we also provide insurance benefits with a product like this. So it will really resonate with a lot of your senior clients or retirees who are looking for insurance features like this. Also, we do have some tax benefits that we're going to talk about shortly. But going back to the target clients, the conservative clients and GIC-focused investors are one of the main sections of clients we like to cater this product towards. And we have prospects that are worried about where the markets are heading, the impact of the market correction. If they're very emotional, and I know we have a lot of clients who, no matter if they're up 10%, 20%, they're happy. But if they're down 5%, it's the end of the world for them. So if you do have clients like this in that category who are who are, I guess, very sensitive to market swings, then this is also a good solution for them. Seniors that are looking for estate and tax efficient ways to transition their wealth. Even if you have younger clients who are saving up for a big purchase like a house, it could be a good solution or vehicle to lock it in for 2 years and have it grow over 2, 3, 4, 5 years. So 2 things I want you to at least take away from this presentation today is about our Guarantee Advantage is the performance. And when I talk about performance, I want to go all the way back to its track record. So we're one of the first comers for this kind of a solution in this industry. Started back in 2001, so it's been 21 years. We've been curating and designing a product like this. Guarantee Advantage in itself, this product was launched in 2009, which was also in the midst of another Great Recession. But since then, our average annualized returns have been around 5 to 6%, which if you compare it with the GIC, it has outperformed GICs over the last 10, 12 years. So it's positioned very well. It has very attractive returns considering the protection it provides. And the other feature, other top of mind item I want you to remember about GA is insurance features. And Desjardins is a differentiator when it comes to insurance features. We have beneficiary designation that comes with it, guaranteed death benefit, no fees upon death, so you can bypass probate as well. And there are tax benefits like pension income tax credits. If your clients are over 65, they're eligible for pension income tax credits. You can also be eligible for tax deferrals as well. So these features are very instrumental in helping you choose between other solutions in the market. I won't talk about the structure too much. I'll jump into a snapshot of what you can expect from this. Now, this is a snapshot of our 2-year term that we're offering right now. I know there's a lot of numbers and a lot of figures here, but I would like you to focus on the column in the middle, the global opportunities with the return range of 6 to 11.2%. What this means is that if you have a client who has $100,000, you put them into a 2-year term, the minimum guaranteed return is going to be 6% over 2 years. So over 2 years, they're guaranteed 6%. That's the worst case scenario. On the other side, the best case scenario is they can get up to 11.2% over 2 years if the market ends up performing well. So obviously the returns can also be anywhere in between the range. It can be 7, 8, 9%, but at least you're guaranteeing a 6% minimum return. And if you're bullish about the markets in 2 years, and 2 years is actually a long time for markets to slowly start recovering from this, they can get up to 5.45% of total returns, which is much higher than what the GIC rates are now, because GIC rates have gone down a little bit over the last couple of weeks. So this can be a good solution for at least the GIC refugees right out there. Another option that we have, and now if you sort of shift towards the columns in the right, if you have more, I guess, aggressive investors, or at least investors who want to participate in the market more, and they really want to utilize the growth in the next 2-3 years, you can put them into that, or you can offer that kind of solution to them where over 2 years, their principal is fully protected. That's the worst case scenario. Best case scenario is they can get up to a maximum of 26% returns over 2 years. So obviously the return potential has increased, the cap has increased. So this can be another feature. One last snapshot that I want to provide is the 4-year term, for example. Here, this is for clients. Let's say if you have clients in the mutual fund who are in mutual funds, you can just put them into a 4-year term where there is an unlimited return potential. So in this case, there is no cap. They are participating with the market fully over 4 years, and their principal is fully protected. The only caveat is it's locked in. So you'll have to have that discussion with your clients. And I know a lot of clients who are okay with locking their funds in. They just sold a house, they wanted to grow. So that can be a good point of discussion with these clients. Speaking of locking funds in, you will also have a lot of clients who are not comfortable locking in all of their funds. They reach out to you. They're like, hey, Graham, I have $100,000. I love this solution, but I don't want to lock in $100,000 for 2 years or 3 years. Give me some other ideas. What you can do is we have another solution, which is called a redeemable term investment. Works very similarly to a redeemable GIC. With just one application, you can combine a redeemable term investment with a guarantee advantage. If we look into the rates for a redeemable term investment, and I'd like you to focus on the 1-year rate specifically, it's where we're offering 4.5% with a 1-year redeemable term investment. So if your client comes up to you with $100,000, they want some liquidity, you can allocate 60,000 towards a GA, and then the rest 40,000 can go in a redeemable term investment with 4.5%. At least in that way, they have some liquidity, they have access to cash if they need it over the period of time. And you can do the same with clients who are riffing. You can use the same idea with the clients who are riffing. You allocate the portion that will be used to meet their minimum RIF payments towards a redeemable term investment, and the rest you can lock it up for 2 years in a guarantee advantage and have it grow. So you can use it in a lot of different ways with a lot of different clients. So I've covered the benefits and how you can use guarantee advantage. Sometimes you can use it as a parking spot. I know that a lot of us, we don't know what's going to happen. Use it as a parking spot for 2 years. And then after 2 years, once you're more certain and clear about the level of direction where the market's heading at, you can reinvest it into a mutual fund or a SEC fund, whatever it is. But this could be a good parking spot. This is very timely. And it's also important for me to note that these, just like GIC rates, we change the features of this product every 3 months. So right now we're offering great features. Maybe in 3 months, after 3-4 months, the new campaign that we launch might not be as attractive. So it is a very timely and topical solution out there right now. And why should you choose Desjardins Guarantee Advantage? This is a very good table that sort of separates a guaranteed advantage with the other offerings out there. So mutual funds, SEC funds, and GICs. In terms of guarantee, the guarantee advantage provides that guarantee, which mutual funds don't. We offer market participation. GICs don't provide that. We offer death benefit guarantee. GICs and mutual funds don't offer that. And lastly, low cost fees, which SEC funds are notorious for their high fees. But here's a quick disclaimer: there's no fees with the GA, by the way. So there's zero fees. You save up money for your clients on that area, and it's a great value proposition that you can bring to your clients when you say that there's no fees, zero MERs for this. So it checks all the boxes, as you can see, and why you should trust Desjardins is because, as I've mentioned, we have 25 years of expertise. We have quarter of the share in the Canadian market for structured products. That's what the market-linked GICs and term investments fall under. So we do have a very big share, and we partner with a lot of investment banks around the world and outsource their expertise as well. And lastly, we do have a 10-year winning streak of being the best structured product house in Canada. So you can trust us, you can trust our expertise and experience with that. So that is it from me. I hope this has helped. If you do want to talk about it in more details, feel free to reach out to me personally. Graham will be willing to share my contact details, but I'd love to talk about it more if you want to know more about this solution at Desjardins. But I hope you enjoyed this, and thank you so much again. And yeah, I'll pass it on to, I guess, Vic or Graham.
Graham and Sadaf, thank you very much. Hi, everyone. Vic Raye, National Director of Banking Services for IDC in Vancouver. And most of my comments today will be on RRSP loans and a little bit on TFSA loans as well. However, I'd just like to come back to one of the points that Alex mentioned regarding just regular mortgage renewals. And the point that I'd like to emphasize is that in addition to finding out when a client's mortgage is due, is to really position the concept of planning ahead. We all are aware of the reality. I'm sure we've gone through it ourselves where, 3 weeks out before a renewal or as a purchase date approaches, we're scrambling. This is a great time of the year to reach out to clients, especially small, medium-sized business owners of any type, and ask them what their mortgage situation looks like for 2023. I can assure you that with mortgage rates going up, people with mortgages, guess what? They're thinking about their mortgages. And I think all you have to do is say something like that to the effect that you have bankers who are calling on you, competing for your mortgage referrals, and that you'd be happy to arrange an introduction. And really position it as a planning exercise so that they aren't caught scrambling last minute. And I'll come back to business owners again, because quite often they're drawing down just enough to maintain their lifestyle. They may, if that's enough to get them the house that they're looking for or to refinance to the way they're looking for, then superb. They can go to one of their current big bank and they'll be well looked after. But we're finding out more and more that in this particularly rising interest rate environment, that's not likely to happen. And they'll turn to you for all sorts of things, wills, accountants, other types of advice. Absolutely no reason why you can't be a real great source of help for them on the mortgage front. So I just wanted to expand a little bit on the point that Alex set up for me. And what we'll do now is go into the RRSP and loan side. This is actually, and TFSA loan side, this is actually one of my favorite presentations. It's perhaps the smallest lending segment that we deal with, that you as advisors would deal with. The average RRSP loan is just a little over $3,000. But it's really important strategically because RRSP loans are one of the top reasons Canadians go to their bank. So another example of how we can build some fences around our clients. And from that standpoint, what I've also heard, which is always a little bit, unnerving. From time to time, I hear advisors who say that the client didn't think of them to go to an RRSP, to go to them for an RRSP loan, even though they manage their RRSPs, which is a little bit of a contradiction. But nonetheless, people are trained. I think that example shows how trained people are to immediately think of a bank when they think of a loan need. This is also a huge untapped market. It's a massive untapped opportunity in the sense of roughly $500 billion of unused RRSP room is out there. Now, of course, with the recent run-up in inflation, market downturns, it's quite possible that people will be dipping into their RRSPs a little bit going forward into 2023. However, having said that, it is still a massive marketing opportunity for yourselves in terms of a huge need out there that people have to continue to build up their savings. What I'd like to touch on over the next few minutes are some key points that we can all use that cover both the actual strategy and the marketing of RRSP loans. So let's first of all just talk a little bit about what the RRSP borrowing sources are. Yes, RRSP loans, but let's not forget personal lending instruments that the client may already have in place that you may or may not be aware of. So if they're a homeowner, perhaps they already have a HELOC that they can draw down on. Of course, we're very fond and we have had great success with BMO's Ready line. We've also continue to have strong, stable growth with the Manulife One for Manulife Bank. There's also non-mortgage lines of credit that, again, individuals have. They charge a slightly higher rate than a home equity line of credit, but still a great convenient source to go to for clients who are in a crunch, who perhaps did not think ahead to reach out to you for a loan, an RRSP loan. The key with RRSP loans is to use the refund to pay back the borrowed funds. That is absolutely vital. Otherwise, you'll find yourself, the client will find themselves in a situation where they're always behind, always struggling to catch up, not only on their loan that they currently have, but also to start making payments so that they don't fall into a situation where they have to borrow again in the following year. Loan strategies. There are approximately, well, there's roughly 3 core strategies. And I would say that it's this first one that we're likely to see a little bit of reduction in this year because of rising rates. And that is the 100% borrowed contribution, but still within the standard 1 to 2 year repayment terms that most of our RRSP loan providers offer. So this could be a one-time loan, or it could be recurring. The client would need to pay off the loan, of course, and then start contributing to the current year to avoid future loans. This is going to be, I think, a tough one if the client does not have any personal savings, given where rates are, which we'll talk about in a moment. The second one is the one that I like. It's a top-up. Again, using the standard 1 to 2 year repayment terms that most of our loan providers offer. This one seems to capture most of the types of clients and the comfort level that clients would have with taking out a loan, particularly in this environment. So the example I used is that you see here is $5,000 as a personal contribution from personal savings. Add to that a $5,000 loan, $10K in total at a 40% marginal tax rate. That's going to kick back $4,000 as a refund, which can then go to pay off most of the $5,000 loan. There'd be $1,000 left, which would work out to a very small monthly payment over the course of a year. And this is by far and away, I think, one of the best ways to position the RRSP loan with some personal savings. There's an actual formula that you can use to calculate the amount of the loan so that the refund actually pays it off. And that formula is right there. I've written it for you, where you take the loan amount, in this case, $5,000, multiply that by the marginal tax rate, in this case, 0.4, divided by 1 minus the marginal tax rate, in this case, 0.6. And that'll give you a number 3,333. So that's the amount of the loan for a total contribution of $8,333. And the total refund on that will pay off the $3,333 loan and leaving no balance. So that's a really, I think, cool way to position it as well for clients that you actually don't want them to have any loan left that they're worried about, and they can start contributing fresh for the current year. Another great market, a really interesting market, is the catch-up market. And the terms there in terms of repayment range from 1 to 10 years. So, and we've actually seen a couple of these come through where it's a substantial catch-up amount, up to a maximum of $150,000 actually, which is what Manulife Bank's maximum is, and they have the highest that I'm aware of out of the carriers that we work with. So there's two clear markets here that I also want to touch on to finish off some of the marketing points here, which is that you're looking at younger clients. So you're looking at essentially the top-up market that I described earlier, as well as the home buyers program type of client. And for many, this is going to be their first bank loan. And it's a great way to connect to the next generation. And in many cases, we're actually, in some cases, talking about the adult children of many of your existing senior clients, elderly clients. So it's a great way to connect to the next generation. And there's people in their 40s, 50s, 60s who actually have not maxed out on their RRSP room. So this may not always be necessarily a younger market, but that then leads into the 40 plus, which is definitely a top up and especially a catch-up market in a very significant way. So as you can see, I'm really excited about this market. The average RRSP loan in Canada is about $3,200. I think I mentioned at the beginning. If I didn't, then there you go. It's a pretty small number, but there are so many neat ways to use this market to position yourselves. And the beauty about lending, as you've heard me say many times, is that it's client-driven. Everybody knows where to go to get a bank account, to ask for a loan. So there's a natural built-in willingness to want to reach out. We just want to make sure they reach out to you first. TFSA loans, again, a couple of key market points. I know Alex touched on this. The maximum catch-up loan is $81,500 for 2022. It's going to go up to $88,000 in 2023. I just felt the need to give you a table here that showed how all of those little amounts have now grown into a very substantial figure. Something else that I want to point out is that unlike RRSPs, TFSAs may actually be used as collateral for loans, so for other loans. So that raises some interesting potential that is not available through an RRSP loan. Now, what I'd like to really do is spend some time on this lovely summary, which I like to do every year. I spent the last few days just updating it, and as of this morning, it's been posted on our IDC WIN banking webpage. At the very top, there's a link to this document. And actually, given the time, we probably won't be able to spend as much time on this as I would like. So I'll just maybe give you a couple of the really, really quick highlights. One of the main reasons I did this, and I've highlighted in yellow, is to give you a sense of what are the rates that are out there. So let me just give you the bottom line on this. The best one-year rate that I could find would be it's down here in the bottom corner. I hope you can see my cursor. It's 6.7 minus their 50 basis point rate promo that is in effect until Feb 10. So that'll take it down to 6.2. So if you're looking for a one-year repayment, the 6.2 is the lowest I could find. And if you're looking for a 2-year term, the best was up here in the top left corner at 6.45 from Manulife Bank. So that gives you a good sense of what the rates are that we're looking at today. And yes, they are double roughly what they were a year ago, if not more. So TFSA rates also are here as well from B2B Bank. As you can see here, I've highlighted them for you. And you're looking at 6.7 if you wanted to do a TFSA loan. And that, of course, is still only available through B2B Bank for some reason. I'm actually quite surprised that no one else has moved into the TFSA loan market just yet. And what I also want to just mention to you is on the right, I've sort of expanded out all of the links that I could find that I thought were helpful, either for rates or general marketing material or just the process. And so think of that last column as sort of a mini RRSP loan toolkit. I know we have the RRSP toolkit that we've started doing for you in the last couple of years. This would be sort of just the RRSP loan side of it, with all the links that you'd need from our core partners for that. All right, in the few minutes that we have left, again, just some strategic points for you as advisors, for all of you as advisors to consider in terms of the new environment that we're in. Not that long ago, we were checking all of these boxes as green. So, of course, interest rates are one of the biggest factors to consider, especially since the interest is not deductible for either an RRSP or a TFSA loan. Of course, we've already talked a little bit about how that looks today versus a year ago. The investment strategy. Having said all of that, I know many of you have had some strong fund manager selections over the years that you very much believe in and encourage clients to go into on a dollar cost averaging in basis, no matter what the market conditions are. So if you are very, very strongly in support of a particular fund manager, absolutely still consider doing the RRSP loans. And this is certainly a good time to consider the dollar cost averaging in strategy if there ever was one. The client is always the key to this decision. They have both financial and behavioral considerations, and you would know your clients best to determine where they fall into both of those categories. Needless to say, I think that in this particular time, it's going to be a little more challenging for clients to want to pursue a loan strategy if their future is any if there's any major uncertainty in their future from employment or from just budgeting. This is an area where, as an advisor, we can certainly help generate the interest, but it still has to meet the client's primary goals of staying cash flow positive. So as an advisor, I'll just leave you with the thought that with most lending, which is consumer led, if you build awareness, the demand will come. And so on that point, I've like to just highlight 3 things that you can do to make this at least a conversation starter. It may not lead to the RRSP loan, but again, it's something that we know from marketing research, clients are very likely to want to reach out to you on proactively. So there's great sample client emails and letters. We have a couple on our own IDC WIN banking webpage that you could easily change and specify that you're referring to RRSP loans at this time of year versus just lending in general, which is what the letter does, or mortgages that we have on our website. The carriers have some great letters that I've seen recently that promote the concept of RRSP loans. I'll mention IA in particular. They've got a great piece on this. Razor Plan, which I believe Alex mentioned earlier in his presentation, is a great partner of ours on the financial planning software side. They have calculators that you can link to on your website for RRSP purposes. I've got a little screenshot that I've taken that I'll share with you, and you could just run that as part of your email signature from November to February, sort of peak RRSP season. One of my favorites, though, continues to be the ability to use the Manulife Bank Advantage account in conjunction with Manulife's My Clients software to be able to track account balances so that you can proactively see who has the cash on hand to be able to take advantage of this. So all of those 4 key factors up at the top. The last one there was advisor. You as the advisor, you're perhaps in the best position to control who you promote this strategy to if you've got the tools at your disposal. And I have to say, Manulife Bank and Manulife have really nailed this part of it to help you get in front of people with cash. This is what the Razor Plan calculator looks like. You can absolutely use this on your own website. They've got all these different calculators that you can use, and they actually even explain very easily how quickly you can do it for free and embed that either in your email signature or on your website. This is the My Clients page whenever you log into the advisor portal. I can only hope that all of you see My Clients there on the right and that you're using it every single day. If you had a dashboard of some type, I would absolutely think this is going to be the first thing you're going to want to see every morning. Who are my clients that have cash positions? So just a few points to close things off on the underwriting and application side. We're looking at individuals who have good credit scores. That is always a given. We want to at least ask, what is your credit score? Hopefully they give you a good number. If they ask you, what do you mean by good? You may want to probe a little bit more, but 650 would be a bare minimum. Ideally we're looking closer to 680. And ask them to be frank. Like, if they have an outstanding CRA debt, it's not going to happen. As well as any, other unfortunate, perhaps financial situations that have occurred in the last 7 years. the one thing I have to say about the RRSP loan process, it's very efficient, but it's very automated. So if there is a glitch, if there is something in their credit bureau, it's very unlikely that they're going to be able to qualify and fix that quickly enough to qualify for the loan. So you've got to have a plan B ready to go if they are auto declined. And you want to start this process, I would say, as early as possible in January. Some good news on the compliance side is that for those of you who are life-only licensed advisors at IDC, our leverage policy does not apply to any type of registered business. So you've got to pass on doing any of that paperwork, which does apply to larger investment loans. This, of course, includes contributions from existing lines of credit as well. It doesn't have to be just an RRSP loan specifically. And last point I would say is just please watch out for the WIN IDC WIN operations email that has all the key cutoff dates. It usually comes out in early February. I can tell you that the RRSP deadline will be March 1, 2023, but there's going to be a lot of key dates that you're going to need to be aware of that lead up to that. And so with that, I think we are at a point now where I can say thank you for partnering with us. It's been an interesting year. We hope you have a really strong finish and that you're setting in motion all the things to have a great 2023. And Graham, Alex, this might be a good time to see if there's any more questions. Let me say again, then, thank you very much for your support. It's been a pleasure working with all of you on behalf of everyone at the Wealth and Banking team at IDC, on behalf of all of our BDEs. This has been a superb experience for us, being able to share all of the tips that we have for the year end. And hopefully this will set the stage for a super 2023. Thank you, everyone. Bye-bye for now.